Recently, 3rd January, U.S. struck Venezuela and then captured the President Maduro and his wife. Trump said the reason for doing this is because of drugs, Venezuela's production and smuggling of illegal narcotics into the U.S. But there are other reasons. For some background, firstly, U.S. has high supply of light crude. Crude oil is the sticky substance extracted from deep below the Earth's surface or ocean floor, the natural minerals. They then go through chemicals and processing, then turn into gasoline for automobiles. There are 3 big groups of crude: light, medium, and heavy. The U.S. has high supply of the light ones, but they require high amount of heavy ones. They are very dependent on heavy crude. And you see the import of heavy crude has gone up over the years, 70% already. Countries with high supply of heavy crude are Canada, Venezuela, and Russia. You can start to see the link. Globally, Venezuela's crude output only has a very small fraction. The output is very small because of the poor management of the country and corruption, but they sit on the world's largest reserve. So just look at this picture, then you can see the huge difference. Zooming to Venezuela versus US, it's more than 4 times. They hold 17% of the global reserve. And also, Venezuela's reserves are mostly heavy oil, which is what the US need a lot. For some background, the president took over in 2013, and since then, he pushed millions into poverty. Economy shrank 71%, and inflation is extremely high. And he also pushed a lot of US oil refineries out. But after the strike, you see that the market actually picked up. Stocks increased. Investors feel that the action will not lead to any bigger geopolitical conflicts. And then the main reason of a price increase is energy stocks. They led the gains because of rebuilding Venezuela's oil infrastructure. Chevron is the biggest beneficiary. Trump also said that American oil companies will return to Venezuela and to rebuild the infrastructure. Dollar index also strengthened. In the short term, prices of oil might increase because of supply and delivery problems. But in longer term, this will bring improvement because basically more American oil companies will restart and rebuild there. And let's zoom in even more. Let's look at VIX, the volatility index. Basically, this is a forward-looking indicator of fear and uncertainty. Right now, it's very low. There were a few major spikes. Number 1 is COVID times. Number 2 is the Trump's April tariff shocks. Currently, VIX at about 14.9, and the tariff shock was close to 50. So this means that markets are not really paying attention on fear. But there's one risk, and I thought this is quite nicely said. Hopefully what Trump did will not set a precedent for behavior, particularly around US, China, and Taiwan. But anyway, this is not the main concern now. It's just forward-looking. And also a quick recap on this Bank of America survey that investors are all into stocks. Cash level is at record low. Portfolios in cash fell to record low, and allocation into stocks and commodities increased a lot. Managers were buying the dip. And then tech stocks, especially those revolving around AI and AI infrastructure. What I'm saying is semiconductor and also data center. And onto a quick recap on UBS overview. Basically, corporate earnings will continue to surpass forecasts and especially the tech sector. The tech sector is still driving optimism and proving resilient despite all of the macro uncertainties. Bottom-up earnings estimates will also be slowly revised higher. Profit growth will also be robust. Okay, let's look at China. China ended the year with less gloomy note, where activities expanded. So composite PMI, the blended tracker for manufacturing and services, increased from 49.7 to 50 plus. Large enterprises are the main reasons, but the smaller firms are still weak. Looking at the picture, manufacturing is quite a big chunk for China, the dark purple one. New orders have been increasing. Services also is a huge contributor to GDP in China. So that's why they ended the year with a less gloomy note. So all of these are good signs for China. So then the central bank didn't reduce the interest rates. Basically, the economy is on the right trend and momentum is solid. Let's have a forward-looking view for China equities. So, closing the year first. This picture is the breakdown of global market performance. China is top 5, and tech is the key driver. Chinese equities gained 22+% by late December. The private sectors, they remain as the key catalyst. Private companies are getting more attention and funding and support from government. This will bring greater confidence in investors. The private companies are less likely to face abroad policy disruptions, right? Like the sudden clampdown in tech sectors back then. And there's better financing for the private companies from the government support to grow the private sector. So basically, this marked the concrete steps to reinforce the supportive environment. Chinese tech continued to be a bright spot. The gap between US and China tech is narrowing. The prominent ones are the AI companies, and China ones are quite strong too. It's not just all US that has strong ones, and you see the intelligence and speed score ranking on the right. AI is enhancing Chinese companies' efficiency and quicker in acquiring customers as well. All of these on the right are some outlook and comments about improving R&D, efficiencies, improving growth, marketing revenue because of AI, and then the support for AI semiconductor. So back then, Trump banned NVIDIA from selling chips to China, but now it can enter China with the H200 chips. All of these are positive catalysts. And China also aims to be self-sufficient in semiconductor. They don't want to purely rely on foreign supplies. Overall, for tech and semiconductor, they will lead earnings growth and are very well positioned. Communication sector will also benefit from AI integration and improved efficiencies. Then, consumer discretionary currently still has pricing issues and also weak demand. This will weigh on near-term earnings. Now into the bigger challenges. Property currently still isn't really recovering. It weakened in October. Authorities are planning to focus more in reducing the built but unsold units. They might purchase more unsold homes. And then, demand is still weak. In first half of 2025, retail sales improved because of the consumer trading programs. But when the program stopped, you see retail sales drop. The authorities plan to increase support. China have been struggling with deflation, very, very low and weak inflation, which is bad. But towards the end of the year, inflation picked up a little. Goldman Sachs mentioned that the headline CPI was largely supported by higher prices of fresh vegetables amid a supply shortage due to adverse weather, while the core inflation figure was helped by the surging gold prices.